Well, the best case is probably the two that the Fed has plotted in their dot plot. So I don't see anything in the comments that she's made today or the minutes this week or the comments last week which really changed that. I think she's just emphasising over and over that they think the US economy is strong enough to justify and withstand interest rate hikes, but it's not so strong and the risks are still there that mean that those rate hikes have to be very gradual. So I'd stick to that line. One thing is evident from all of this, and that is the Fed is very concerned, very conscious of the risks regarding the global economy, and it doesn't want to do anything to upset that sort of balance going on. So therefore it's going to remain a very gradual process.
Yeah, is this global equity rally, Shane, running out of puff right now? It seemed to be fun while it lasted, but do we go lower from here? And tactically, is capital preservation the way to go now?
Well, I think we're still in a fairly rough part of the cycle. We started off on a very rough note, then we had a great rally. US shares running up 12–13%, I think, from their lows in February. Other markets to varying degrees, but I think the US has been the strongest of them. The trouble was that rally went a bit too far too fast, and now, of course, we're seeing some of those concerns about the global economy creeping back in. And part of that recently has been accentuated by the continuing rise in the value of the yen, which makes investors fearful that the carry trade is sort of continuing to unwind, and that's also seen as a bit of a negative in all of this. But I think at the end of the day, as long as there's no recession in the US, and I think Janet Yellen made some comment, Ben Bernanke rather, made some comments about that in that session. If there's no recession, I tend to think there won't be. If there's no recession in the US or globally, then after a bit more volatility in markets, we should see share markets higher on, say, a 12-month view. Just a bit of uncertainty about the short term.
Yeah, Shane, I just want to pick up on the yen at 18-month highs. Very destabilising for corporate Japan, especially the exporters. Is the currency a victim of its own success? Is it safe haven flows that are driving it higher, or is it an utter lack of faith with QQE and now negative rates?
I think it's a bit of both. I think when Abe was elected and QQE was ramped up over the last few years, that led to a ramping up of carry trades. And of course, when there's uncertainty, if you've got more carry trades on the table, there's more to be reversed when that uncertainty comes along, like we've got recently. So consequently, we've seen the value of the yen rise by about 14% from the low point that it was at around the middle of last year. So that is clearly a concern for Japan. I mean, in some ways it seems a bit perverse. Earlier this year, the big worry was that the US dollar was too strong. Now, of course, investors are worrying that the yen's too strong. So it almost seems like there's nothing that can keep investors happy. But I think at the end of the day, it is a bit of a balancing act. At some point here, I think the BOJ will step in again, probably before we get back towards the 100 level. But I think the BOJ will step in, and ultimately we'll see the yen stabilise and start to decline again.
Shane, a quick last one. You've got a Fed rate hike penciled in for the June meeting. Isn't that going to be complicated by the Brexit vote on the 23rd of June? Because my sense right now is that it's not just a localised risk event anymore contained to Europe, but a global one. Is that going to complicate the Fed's decision-making process when it's so focused on the international stage?
Yeah, I must admit, I think it does. I'd say very little chance of an April move. The next logical one is the June meeting, because after that they have a press conference. So I've sort of penciled it in, but it's only a 55% probability. And I think if we get to that meeting, which is only a week prior to Brexit, if we get to that meeting and there's too much focus on the Brexit vote, too much uncertainty around it, then I think the Fed will simply delay and maybe consider looking at the July meeting. But I'd have to agree that there is potential for the Brexit meeting to cause a Brexit vote to cause a delay in that hike and it come a little bit later. At the end of the day, I think Brexit can be overstated here. Even if Britain does decide to leave, it's not as if Britain is actually leaving the Eurozone, it's actually just leaving the European Union. So it's not quite the same thing as, say, a Grexit would be.